Hello everybody, welcome back to another valuation investing video. And today in this video, I'm going to be going into Trade Desk stock because this stock has had a really rough 2025 and I wanted to see whether or not we should be buying the stock due to this huge discount. So with that being said, in this video, I'm going to be starting off with Trade Desk, looking at the fundamentals, looking at why the stock is actually down so much. Then at the end of the video, I'll be using my intrinsic value calculator that I've created on my own to get a fair value price for Trade Desk stock and to see if it would be a good time to buy today. So with that being said, let's get into this video. Taking a look here at Trade Desk stock, as I said, this stock in the year to date is down 54%. So this stock has been doing very bad this year. So with that being said, I'm going to be going and taking a look at why the stock is actually doing so bad. But first, let's take a look at what Trade Desk actually does if you don't already know. So what is Trade Desk? Take a look at what the Trade Desk does. They provide a cloud-based platform for advertisers to buy digital advertising through a process called programmatic advertising. It allows buyers to manage ad campaigns across various formats and devices using data to target specific audiences and optimize performance. The company offers a self-service interface for agencies, brands, and marketers to plan, execute, and measure their digital ad spend across connected TV, video, audio, and other channels. So what they basically do is offer software where people can manage, advertisers can manage their advertisements and their campaigns for those advertisements. First, take a look at their platform for buyers. The Trade Desk platform is a demand-side platform that empowers buyers to purchase ad inventory. They also offer automated buying. It uses automated data-driven methods to bid on ad space in real-time auctions. So it helps advertisers get more ads with efficient ad spending. Also, they have omni-channel campaigns. Buyers can use the platform to create sophisticated campaigns across numerous digital channels. Also, they have data-driven insights where they help give advertisers analytics on how their advertisements are doing and the performance of it. And they also offer client base, include advertising agencies, brands, and marketers who use the platform to execute their advertising strategies. But why is the stock down 55% year to date? It's down 55%. That is a huge drop in the stock price. So let's get into why it actually is down. Take a look at why the stock is down. The main factor is the slower revenue growth and weak guidance from the company. In their recent earnings report in August 2025, they showed a deceleration in revenue growth, and the forward guidance for the next quarter was lower than expected. Although some of the slowdown was attributed to tough comparisons from a political ad spending boost, which just technically year over year, 1 year ago, that was when the presidential election happened. So they had a lot more ad spending back then, but people were still expecting higher expectations for their growth in the future. And with that being said, with that coming in short, we had a big drop in the stock price. Also, we have intensifying competition with Trade Desk. First, we have competition in the digital advertising space, particularly in connected TV, is heating up from major walled gardens like Amazon, Microsoft, and Google. News of Amazon partnering with Netflix to help marketers buy ads was seen as a significant competitive threat that could potentially erode the Trade Desk market share and pricing power, especially in premium ad inventory like Netflix's ad slots. Amazon is also making inroads with the demand-side platform, leveraging its first-party retail data, which is highly valuable for advertisers. So the two main things, we have weaker revenue growth and weak guidance, and intensifying competition. So that's the one thing I really don't like. I'm not even too worried about the slower revenue growth and weak guidance. As long as it's still growing at a decent rate and you pay the right price, that's fine. But the biggest problem I have is the competition with this company. Even though there is some competition, I want to get into the growth prospects for Trade Desk because there's still a bunch of growth prospects. First, taking a look at the connected TV dominance from Trade Desk, they have the shift from linear TV from cable broadcast to streaming platforms. So they offer, as we can see here, it allows advertisers to manage and measure campaigns across almost every ad-supported streaming service of Disney Plus, Hulu, Peacock, Paramount Plus, and even more. Also, they do live sports. The company is actively working to integrate programmatic buying into live sports streaming. Also, they have Operation System Strategy, Ventura, the collaboration with DirecTV to integrate its Ventura TV OS signifies a move to embed its ad tech directly into the consumer interface. Also, we have retail media explosion. Retail media involves placing ads directly on a retailer's website or app, and Trade Desk is positioned to capture ad spend that currently exists in the walled gardens. Now, also, we have some other things like identity solutions with Unified Identity ID 2.0. With the eventual demise of third party cookies, Trade Desk's industry wide alternative, Unified ID 2.0, is a major long term growth opportunity. Also, we have international expansion. If Trade Desk can go international, this could really help them because they're dominating in North America. However, there's a lot of other places out in the world for this to happen. They have a low revenue base. A significant majority of Trade Desk revenue currently comes from the US. Finally, we have the AI and platform innovation. The continuous improvement of its core technology keeps it competitive and enhances ad performance for clients. They have the Kokai platform. Hopefully, I'm saying that right. The Trade Desk's latest AI enhanced platform, Kokai, is designed to improve campaign optimization and decision making by analyzing up to 15 million ad opportunities per second. So with this AI, it's actually going to help them become more efficient for their clients and potentially get more people to become a part of Trade Desk and use them. So with that being said, with these growth opportunities and everything we just looked at, let's go over to my valuation investing website. Taking a look at my valuation investing website. If you want to go check it out, just look up valuationinvesting.money, or you can just go to my Patreon and get a 7-day free trial for the website. But if you already look up the website, it's automatically going to have you sign up for it. Get a 7-day free trial, and then it's only $8 per month, and I think it's definitely worth it. Just go ahead, check it out if you want. So let's put in Trade Desk stock. Let's put in ticker symbol TTD. Taking a look here, we can see if we scroll down to the overview, we obviously have what the company does, but taking a look at the value of the company, trading at a $26 billion market cap. We have the PE ratio pretty high at 65, but the forward P ratio pretty low at 27, so that looks good. The price to sales is pretty high. The price to book is pretty high. So the valuation seems a bit high for Trade Desk. The free cash flow yield doesn't seem too bad at 3%. And taking a look at the net cash, they actually have $1.35 billion in net cash. This looks very good for the Trade Desk. We have a lot more cash than debt. They can pay off this debt in no time. So this looks good in the terms of the balance sheet for Trade Desk. Taking a look at my 7-step stock analysis, this gives us a quick overview of the fundamentals. So taking a look here, we get 6 out of the 7 key metrics. We have the forward P ratio less than 30 at about 28, so this looks good with the future valuation. The return on invested capital at 12% also looks pretty good. Revenue growth of 27%, very fast growth, and EPS growth of 97%. So this is very fast growth from this company. The only thing that's bad here is the shares outstanding are slightly increasing. I'm not too worried about that since this is a very fast growing company. If this company was growing at single digits, then I'd be very concerned, like, why aren't you buying back shares? But since this company is growing very fast, there's no real need to be buying back shares at this time. Also, the debt to free cash flow looks very good at 0.4, which makes sense. Also, the future revenue growth looks good from analysts. Taking a look here at the financial charts, we can see the revenue growth looks very consistent. That looks good. Earnings per share looks pretty good, but we did have a huge dip back here. So it still looks very good for the earnings per share. Everything looks good here. Free cash flow, everything looks very good for Trade Desk. Now, let's go to my intrinsic value calculator and input some assumptions to get a fair value price to see what we should be paying for the stock today. First, take a look at the revenue growth. Let's go over to this website, which is called pevaluator.com, and I actually have a code with pevaluator.com. If you want to go down, look up pevaluator.com, or click in the link in the description. You can get 25% off. I'm pretty sure 20% off. You can get if you use my code Valuation Investing. And I really like this website too. We can see the growth estimates for this company about 17% revenue growth, net income 23.5. So with that being said, let's go back to my intrinsic value calculator. With the bear case, I'm gonna say this company grows at about 10%. With the base case, I'm gonna say 15, bullish case 20. I think for the future, I'm gonna be a little bit more conservative than the analysts, just because I believe the increased competition could be slightly worrying with trade desk. So that's why I'm doing slightly more conservative, but I still think these are very fair numbers. Now for the future profit margin, right now their profit margin is at 15%. However, I do think this profit margin will go up in the future, but let's just do bear case 15, base 20, and bullish case 25. I believe they're going to get more efficient because there's not a lot of costs with this company, and they're starting to get to the very efficient profitability stage. If we go back to the profit margins here, let's go back to the profit margins. We can see the profit margins was near negative just a few years ago. So I think this company will continue to get more efficient in the future. Now for the P/E ratio. Company growing at 10%. They do have some competition, so I don't think they deserve a huge premium, but they definitely deserve probably a 23 P/E ratio. With the base case, let's do a 30 P/E ratio. Bullish case, I'm going to do a 37 P/E ratio. Now, if the shares outstanding, I think let's do bear case 1%, base case it increases 0.5%, and then bullish case say they keep it constant. Now, if we calculate the intrinsic values, let's take a look here. We get an annual return of 3.5% for the base case from today's price. So if you believe the base case assumptions, you're not going to make much of a return, so I wouldn't be buying. If you believe the bullish case, however, if you truly believe they can get 20% revenue growth and increase this profit margin by a huge amount, then it looks like a good buy. However, me personally, right now, I don't think I would be buying this company. If I wanted to buy this company, I think it would have to be under $35, $40. Right now, I just think it's a little bit too overpriced for the potential for increased competition in this space and decelerating growth. So with that being said, thank you guys for watching this video on Trade Desk. If you want to go check out the Patreon and get the 7-day free trial, all you have to do is go down here. Right here, just click that button right there. Takes you over to the Patreon. So thank you guys for watching and see ya.